If you own a home and you plan to leave it to your children one day, you will either cost them hundreds of thousands of dollars in taxes or save them hundreds of thousands of dollars in taxes. And it all comes down to one decision: when you choose to transfer ownership of the property. And most people get this completely wrong, and it ends up costing their families hundreds of thousands of dollars in unnecessary taxes. In this video, I'm going to break down the difference between passing your home down the right way versus passing it down the wrong way. And I'm going to show you how wealthy families are able to pass their homes down to their children completely tax-free. All that plus more on today's episode. What's up, family? Welcome back to another episode of Tax-Free Living. I'm your host, Carter Cofield, CPA, with over 13 years of experience. And in the last 5 years, we've helped our clients save over $25 million in taxes. And today, I'm here to help you. So on today's episode, we're going to talk about the American dream of buying a home and then passing it down to your children. Here's the problem. Most homeowners think that gifting their home to their children early is generous. It feels good. You get to see your kids enjoy it while you're alive. It feels like the responsible thing to do. And you think that you're simplifying things before you leave this planet. But in reality, this kind gesture could end up being one of the largest and most expensive mistakes that you ever make. Because when you gift your home to your children before death, your children don't inherit it at today's value. They inherit it at the original purchase price of when you purchased it. And this small IRS technicality could lead to a six-figure capital gains bill when your children decide to sell the property. So let's break it down. The key concept you need to understand here is step up in basis. Now I want to slow it down because I want to make sure it's super simple and easy for you to understand. Your basis is what you paid for the property when you purchased it. So if you bought your home for $100,000 20 years ago, then that is your basis. And if you sell that home today for $300,000, the government will tax you on the difference, which is the capital gain. So this $200,000 difference between the purchase price and the sale price is what you have to pay taxes on. Now here's what things get powerful. When you die, your heirs inherit your property and they get what's called a step up in basis, and they inherit your property at the current market value at the time of your death. So that same house that you bought for $100,000 20 years ago is now worth $300,000. When you pass away, your kids inherit that property, get a step up in basis at $300,000. So if they decide to sell that property the next day, guess what? They have a $0 capital gains bill because they owe no capital gains taxes because the basis and the sell amount is exactly the same. Okay, so now that you understand this term of step up in basis, let's go over two scenarios. The scenario where somebody passed their home down the right way and a scenario when somebody passed their home down the wrong way. In this example, let's say Sarah bought her home 30 years ago for $100,000 and today it is worth $1 million. And she wants to help her son Jake out, and she decides to gift Jake the home while she's alive. So Jake inherits the property at her original basis, which is the purchase price of $100,000. Now let's say a few months later, Jake wants to sell this property that's worth $1 million. Now here's the thing. Jake now has a capital gain of $900,000, the difference between the $100,000 in basis and the $1 million. And at a 20% capital gain rate, that means that Jake would have a tax bill of $180,000. So Sarah thought she was doing her son a favor by gifting the property before she died, but what she ended up doing was passing down an $180,000 tax bill that could have easily been avoided. Now let's go over an example of Sarah doing this the right way. Imagine Sarah keeps the home until she passes away, and she sets up a revocable living trust and assigns the home ownership to her revocable living trust and assigns Jake as the beneficiary of the revocable living trust, meaning that when she dies, the home avoids probate and the ownership transfers to Jake at the date of her death. So when she dies, the house that's now worth $1 million, Jake will inherit that $1 million property, but he will also inherit that property with a step up in basis of $1 million. So let's say a few months later, Jake wants to sell this property for $1 million. He will have no capital gains tax bill on the sale because the step up in basis of $1 million also matches the sale price of $1 million. So now she was able to pass that same house down to her son Jake, but she passed it down completely tax-free. So this small nuance is the difference between her passing down a home in a $180,000 tax bill or passing down the home completely tax-free. And I can't tell you how many clients come to us that have made this mistake, and now their children have a huge tax bill that could have easily been avoided. So let's go over the process again. What is the proper way to do this? So if you're a homeowner and you want to pass down your property to your children, you want to set up a revocable living trust, and you want to assign ownership of the property to your revocable living trust. And then you want to assign your children as the beneficiaries of this trust. So now it's essentially like you're gifting the kids the property, but they will receive the property at the date of your death. So both things happen that you want to happen. Number one, you avoid the complexity of your children have to deal with probate and have to figure out who gets the ownership of the property. But the second thing you do is you also allow them to inherit the property and get that step up in basis. So whenever you do pass away, whether the home is worth $1 million, $2 million, $3 million, it won't matter because they will inherit that property at the fair market value of your death. And this small nuance is what the difference between what middle-class people do and what wealthy people do to build generational wealth for their families. So as we round up this episode, let me give you the step-by-step breakdown to make sure you know how to do this properly. Step number one, keep ownership until your death. Holding on to the property ensures that your heirs get the step up in basis and eliminate unnecessary taxes. Step number two, set up your revocable living trust and make sure you fund it properly by assigning the home into the trust and assigning your children as the beneficiary of the trust. Step number three, work with a tax professional or estate planner. Every family situation is different. An expert needs to be included in the structuring to make sure it's done correctly and make sure your T's are crossed and your I's are dotted. Step number four, if you want to help them out now, gift them cash instead of a property. Liquid assets don't carry a big unrealized tax bill, so you can still help your kids out today without causing a tax problem. In summary, passing your home down before your death might seem generous, but it's often one of the most expensive financial mistakes that most families make. Waiting allows your heirs to inherit the property tax-free, and that is exactly what we want. We want to gift our children all the things that we worked hard for, but we don't want to gift them an unnecessary tax bill. So if you like today's episode, please do me a favor, hit that subscribe button and then share this with somebody, because the more we get this video out, the more people will know how to pass down their home effectively, build generational wealth, and avoid unnecessary taxes. And last but not least, if you're looking for a tax professional or tax strategist or a money team to help you make more money and save on taxes, click the link in the show notes and book a call with our team. We can't wait to help you. Can't wait to see you on the other side of wealth.